Okay, we are back on page 4, and we're going to look at the FVE, or Fair Value Enterprise Method, called the Entity Method, and the fair value of NCI is implied. So in some cases, the price paid by the parent on a per share basis may reflect what would have been paid for 100%. So there wouldn't be a difference like the $7.75 and the $9. So sometimes it's appropriate to measure NCI using the price paid per share to obtain control. And you can just read this, and that's the reasoning there. Okay, so let's do an example to see how it's different. Okay, it's really not different except the first line of the goodwill. On June 30th, and NCI. June 30th, year 3, P, the parent, acquired 8,000 of S, the sub, 10,000 shares for 72,000. Okay, so what percentage is that? Now this part is hardly ever said in a question. It's assumed that the parent's consideration is an appropriate measure for the fair value of the NCI's consideration. In real life, you would have to look at these considerations or these issues and see if indeed you fit that. So to both companies, as well as the fair value of the sub is given below. Now, remember I said sometimes you have to watch for intangible assets? A customer contract, which was not listed on this balance sheet because it was an internally generated intangible asset that did not meet all the criteria you learned in 315, 316. So it was determined to be an identifiable asset. When you see that wording, it means it can be listed on consolidated state and worth 1,000. So we want you to calculate goodwill and NCI and prepare a consolidated balance sheet for the parent on June 30th using the working paper approach, and the spreadsheet's on page 6. So this is very similar to our last example. I've just changed a couple little things. Okay, is this before or after acquisition? Well, it's after. And if I asked you how much the parents paid, if I didn't tell you up in this question, how would you find out how much they paid? Well, if the parent uses cost, this is the price they paid. So watch for something like that. Okay. What other things do we need to consider? Well, I want to do the FV minus CV again so that it's already done for us. So cash is the same, AR is the same, inventory went up by 2,000. Now we get to an accumulated depreciation. We've got 60 minus 10, and somehow we've got to get it to 59. What do we do? Remember, we learned it last chapter, right at the end. Well, the easiest way is the net method, so we net out the accumulated depreciation. So what's the net book value base? 60 minus 10, which is 50,000, and we just cancel out. Okay, so remember, this is a net method, and we need a consolidation entry. Okay, So what ended up happening with the plant? Did it go up or down? Well, it went from 50 to 59. It went up by 9,000. Patent, it went down by 1,000. And long-term debt went up by 3,000. So, is there anything else that's different in the fair value version versus the carrying value of S, of the sub? Yeah, we have an increase, and we'll put it up by the assets, of 1,000 in a customer contract. Okay? So don't forget that, you guys. Always double check for some, they're called identifiable assets. We can package them, we could sell them as an identifiable asset, then it's okay to list it on the consolidated balance sheet. Okay, so watch for those. Okay, so that's our FV minus CV. Now, this is a weird thing that we haven't seen before, is the sub having goodwill. Okay, basically we have to get rid of that. This in the consolidation. So it will need a consolidation entry also. Okay. That's all the analysis we need to do on that. Now, what's the first thing to calculate? Goodwill. And then NCI. So keep this handy. And let's calculate AD and goodwill. Okay, now I'm just going to start us off so we can keep this straight throughout. Price parent paid was 72,000, and the percent in that was 80%. You don't have to write that down, it's not part of the calculation. It just has it all sitting there so we kind of understand. Okay, now looking back at the wording, were there two different share prices given? One for the NCI, the 2,000 shares, and one for the 8,000? No. So, this said it, the implied, I can assume, but if it's not there, you just go, hey, there weren't two share prices, so I'm going to use the implied. So what I need to calculate for our first line is the implied value of, and put fair in there, it should be fair value, sorry. Implied fair value of sub. So what we're saying is what we paid, the 80%, 72,000 for our shares, it would have been the same price for the subs, or for the NCI. Our 80% of our shares would have cost 72,000 for us to buy them. The other 20% we're assuming are trading at a similar rate. Okay? So, how do I figure out what the implied value or 100% of the sub is? Well, how did we 72,000? We know the total price, or the total value, times 80% is 72,000, right? So how do we figure out what the total value was? Well, all we do is we take 72,000 divided by 0.8. All right, 72,000 divided by 0.8 gives us the total value. And that gives us 90,000. Okay, then what do we take off? You should have started memorizing this already, or worse, having nightmares about it. Okay, so we start with that, then what do we take off? So this is like consideration given up, but it's called the implied fair value of the sub. You can also put implied value of the sub, whatever. Of course, in Connect you'll have drop downs. Okay, so we take off the sub's carrying value of net assets. And this is going to be a little different. So we start with the assets, which are 100,000 from the last page. We take away the liabilities of 30,000. And normally we have 70,000 out there. And remember, what was the other thing we could do instead of assets minus liabilities? Common shares plus retained earnings. Okay, remember there was a goodwill sitting there in the subs books? We've got to get rid of that because we're absorbed when we do the consolidation. They can't have goodwill. We've got to kind of get rid of it. So we're just going to, that it ends up kind of in our goodwill. So we're going to take away less subs goodwill. So that's 4,000, and that gives us 66,000. Leave about this much at the bottom, so don't write too big here. Which gives us 24,000, which is acquisition differential. So this is kind of new, okay? Okay, then from acquisition differential, we take less FV minus CV, or fair value differential. All that means is the amount of fair value above the carrying value, how much extra fair value is, or less. So again, looking back at the last page where we did our little FV minus CV, and you don't need to do that, but it's nice too. We're going to put inventory went up by 2,000, and I'm just pulling it off there. Plant went up by 9,000. Patent went down by 1,000. Don't put the debits and credits on yet. I mean, of course you can if you want. Long-term liability went down, up 3,000. And is there anything else we have in there? The custom contract or customer contract. And it went up by 1,000. So put it on pause, do the debits and credits, and calculate goodwill. You should get 16,000. When you're done, come back and I'll go through it. Okay, so inventory, to make it go up, it's a debit. Remember, debit equals positive. Credit equals negative. Just for this calculation, don't throw everything you know out. Plant also went up. Patent went down, that's a credit. Long-term liability went up, that's a credit. And customer contract went up, so that's a debit. How'd you do? Okay, so that goes to 8,000. Well, is 16,000. Then we need, after my pen works, NCI at acquisition. Well, going way back to page 2. On page 2, NCI at acquisition. Do we have a different share price between CI and NCI? No. Instead, we use the implied value, so we just take the implied value of the sub times the NCI percentage. That's it. Okay, so NCI equals NCI percentage times implied value of the sub. So our NCI percentage is 20%. The implied value of the sub, up here we've already calculated, is 1,000. And this was from page 2 of notes. Okay. Now, we are going to do the consolidation entries and then you're going to post them. So I'm going to start another video before it cuts me off, and we'll go through them. Now, unfortunately, I meant to give you another page of blank paper, so you're going to have to flip yours over and write on it to get the rest of the entries. Okay, see you in a sec.